I haven't been this excited about international equities at any point in my career. And I may be dating myself here a bit, but I've lived through most of this chart. The performance of US and international stocks moves in long cycles. Right now, it may feel like US stocks will always do better, but you can see from this chart that they don't. And I think we're in the early stages of a massive shift back in favor of international. In this video, I'm going to take you through the top 4 reasons why. The first one relates to Europe. Every year since 2002, the US government has borrowed more money as a percentage of its economy than the EU, aka the European Union. Not only does that provide an extra direct boost to the US economy over Europe's, but the secondary impact is likely just as strong, if not stronger. Think of it like this. If the government borrows money to build a road that connects two cities, that might lead companies to invest in building a restaurant or a gas station in between. The road might have boosted the economy by providing temporary construction jobs and then making it easier to do business between the two cities, but then it also incentivized private companies to invest alongside to grow the economy even more. There are obviously many things the government can spend their money on, and not all of them are equally productive, but there's generally been more of this government spending to support the economy in the US over the last 20 years straight, and that might be about to change. Germany's new Chancellor Friedrich Merz just announced a major new fiscal, aka government spending plan, that has two key components. First, a 500 billion euro infrastructure spending plan, which is about 12% of Germany's GDP, that will be spent over the course of 10 years. That means they're getting more of that kind of boost I showed in that last chart every year for the next 10 years. Second, defense spending will now effectively be unlimited and is likely to rise substantially. This is the biggest boost to German fiscal spending since the reunification of the East and West Germany in 1990. It is a huge and abrupt shift that few saw coming. Two things led to this. First, the White House meeting where Trump basically called Ukraine's President Zelensky a dictator and said it was Ukraine's fault that they were invaded by Russia. And second, Vice President J.D. Vance's speech at the Munich Security Conference, where he called into question whether the U.S. would actually back Europe in a war. This was an oh crap moment for European governments, and Germany, being sort of the de facto leader in Europe, took the first step. Not only will German spending boost the German economy, but it will have spillover effects to the rest of Europe. And not only will that have spillover effects to the rest of Europe, but since Germany took the first step, and they're one of the leaders in Europe, there's a good chance it will give other countries the freedom to spend more too. This is a significant step for Germany and Europe, and the only question is how significant. Meanwhile, in the US, Musk's Doge plan is shaking things up. So, does that mean the US could be cutting government spending? It remains to be seen, but either way, this is a groundbreaking moment for Europe that will give a decade-long boost to European economies and the stock market. The second major development for international stocks is also related to Europe. I can't predict when, maybe 2025, maybe not, but at some point, the war in Ukraine is likely to end. That would do two and potentially three big things to boost European equities. First, there would no longer be a war going on in their neighbor's yard. That would have obvious psychological benefits, and all else equal, higher risk means lower stock prices. When a perceived risk goes away, stock prices go up. It's hard to say quite how much that boost would be, but Goldman Sachs calls it, quote, significant. Second, the attention would likely turn to who's going to rebuild Ukraine. And the answer is probably a lot of European industrials and chemicals companies. The US is more tech-oriented and Europe is more industrial. Not to mention those companies are closer, and Europe would probably be the one funding most of the rebuild, so European companies would likely get a lot of that business. And third, maybe Russian gas might even start flowing to Europe again. If that happened, it would be a huge cherry on top of the already delicious ice cream because it would lower costs for pretty much everybody across the board in European economies. So you've got fiscal spending, which is a huge step change versus the last few decades and will provide a boost to European economies for at least 10 years. And the end to the war in Ukraine, which we don't know when it will come to an end, but it's highly likely to happen in the next 10 years. And when it does, it would likely be another big boost for European stocks. The third big change coming is in China. And actually, there are three major events that have happened in the last few months that all sort of link together. But first, let's level set to where we've been. For most of the decade from 2015 to 2024, US stocks in blue and Chinese stocks in red were relatively even. Then, from 2021 to 2023, Chinese stocks got smashed and actually fell more than US stocks did during the 2008 financial crisis. But this year, it's been a very different story. So, why is that? Well, let's start with the first of their three big changes, which came back in September 2024. China announced that they were going to come out with a plan to stimulate their weak economy, which led to the biggest single day rally in Chinese stocks since 2008. They ended up rising about 40% in under a month before giving back a lot of their gains afterward. While it didn't end up being the massive stimulus investors hoped it would be, it was a significant step forward. President Xi finally publicly acknowledged the problems that had been ailing Chinese economy for years and showed a willingness to fix them. Here's what I said in our video from last October, what I more or less called exactly what was going to happen. Well, this makes me more confident in an eventual recovery. The Chinese stock market is prone to strong, sharp, short-lived rallies, and this feels like it could be another one of those. The rally was short-lived, and Chinese equities did sell off, but then it came back as more positive news started pouring in. Mainly, I think the significance of the September announcement was that President Xi signaled his willingness to do whatever it took to stabilize the economy. That did not mean that it was going to take off like a rocket ship, but what it told me was that the worst was likely behind us and future weakness would likely be a buying opportunity. That brings us to the second big piece of news in China. An AI company called DeepSeek came out with a large language model that was on par with the big American ones, but cost a fraction as much to train and run and didn't require any of NVIDIA's most advanced chips to do it. That ended up sparking a wave of AI innovation and optimism in China, similar to what we've seen in the US over the last couple of years. I've long been in the camp that we were going to go through a painful adjustment period in AI stocks where the market would realize that the early stage AI winners might be different from the long term AI winners, since that's basically how every major technological advancement has gone. Usually, it's the enablers of the technology that win it first, like AOL and Cisco systems in the internet bubble, or NVIDIA and the hyperscalers like Microsoft and Google in AI. But then it's the users of the technology that win in the long run, like Meta, Amazon, and Netflix for the internet and CBD for AI. Some companies, like Google in the internet era, can be winners of both phases, but a lot of companies probably won't be. We might be going through that period right now, and DeepSeek might have helped accelerate that. Here's what I said in our top 5 ETFs for 2025 video. I just don't find US large caps very attractive right now. And here's what US stocks in blue, European stocks in green, and Chinese stocks in red have done so far in 2025. That video was released on January 1st, by the way. Now might be a good time to hit that subscribe button if you haven't already. The third big change in China was that President Xi held a symposium in February with all of China's top business leaders, including Jack Ma, the founder of Alibaba, who he'd previously had a falling out with. This was a huge sign that things are changing in China because ultimately the underlying issues with the economy can all be traced back to confidence. Extended lockdowns, a property market bust, and a crackdown on tech companies all played a part in China's confidence crisis. I'm not saying all their problems are fixed, but if you wait for that, you'll miss the whole market recovery. I think this symposium is a really critical early sign that the tech crackdown might be over and the mood is shifting. Take these three things together, and you have a government backstop to help counteract any negativity that might come from the US China trade war, and investor enthusiasm, and a revival of business confidence, at a point where the stock market is still down over 38% from its peak in early 2021. So you haven't missed the whole rally. Just like the events in Europe, we're starting from a really depressed valuation, and there are multiple significant changes for the better going on that could support the market for years to come. And just like in Europe, a recovery in China could have wide-ranging impacts on the economies that are closely linked to it, like other emerging markets, and quite frankly, most of the world actually. These events are good for global stocks, but in my opinion, they will be the most positive for non-US stocks. The fourth area is related to the first three, but it represents secondary effects that could add to the rally in international equities over the coming years. That's the dollar. If we go back to the first chart we showed, you can see that the shaded areas are where the US or international stocks were leading over rolling 5-year periods. The gray line is showing whether the dollar was strengthening or weakening. Generally, when the dollar is strengthening, that's a boost for US equities, like it has been for the last decade plus. And generally, when the dollar is weakening, it's a boost for international equities. I think the dollar is likely to weaken. Currency strength is driven by shifting demand for assets denominated in that currency. So if more non-US investors are buying US stuff like stocks, treasury bonds, or whatever, there's net buying activity in the dollar and the dollar goes out. That same happens in the opposite direction. There have been two key drivers of the strong dollar of the 10 to 15 years, both of which I think are likely to change. Number one has been equity flows. Tech has been the dominant sector by far, and over 80% of the world's tech stocks are based in the US. I already covered why I think there's an adjustment period coming for US tech stocks, which may already be underway, so there's no need to belabor the point here. If tech is no longer leading, and there are more investment opportunities in places like Europe and China, equity flows will likely go back outside the US and weaken the dollar. Number two has been bond flows. US interest rates have generally been much higher than non US interest rates in countries whose bonds are just as safe, like Japan and a lot of European countries. And if you can earn a way higher return with no extra risk, why wouldn't you? Well, that's what a lot of foreign governments and institutional investors have been doing. They bought treasury bonds because they offered much higher returns than government bonds in their countries. But higher growth rates and more borrowing in Europe are likely to push up bond yields, while US yields could fall under the weight of potentially weaker US growth from a combination of Doge disruption, tariffs, and just the broadly uncertain environment we're likely to be in for a while. This reversal of the stock and bond flows could weaken the dollar, which would be a big boost to non US equities. Now, I'd be remiss if I didn't mention some of the risks. And of course, there are many, as always, but the trade war is the obvious one we've got to talk about. It's very likely that Trump will announce more trade restrictions on Europe and China over the coming months, quite possibly starting this week. So there can and most likely will be some volatility ahead. But just like I said in the China video from October, the underlying positives are so big and so long lasting that I find it hard to see anything other than a major global decoupling derailing them. Obviously, if something drives all global stocks down, these will probably go down too. And there is likely to be country or region specific headlines that impact prices. So I don't expect it to be a smooth ride, but I would be very surprised if international stocks did not beat US stocks over the next few years. I know not everybody wants to hear it, like this person who seems to have left our Discord after I pointed out the notable absence of international stocks in his or her portfolio back in December, but I really think people who are 100% invested in the US will come to regret it, like that person probably is right now. If you found this video helpful, hit that like button, leave us a comment with what you'd like us to cover next, and hit the subscribe button so you won't miss it. And if you want to connect with my partner Kyle and I directly, you can do so by joining our Discord, which has an active community of over 400 people helping each other become better investors.